Hi everybody and welcome back. We're doing lecture number 3 on IFRS 17 and basically covering just a variety of different aspects of IFRS 17. So in the first video for this lecture we covered profit timings. So that one's now done. And what we'll do in this video is do the groupings section and probably just do the groupings and then close the video and then come back for the other ones. So let's kick off. Let's give ourselves some space. So we're going to talk about groupings. So when we did our earlier example, we were basically talking about just one contract, but that's not quite true. When you end up doing your IFRS 17 assessment and thinking about CSMs, you're required to split all your contracts into groups and do your calculations for each of these groups. And the groupings are important because they can force the calculations to change. So you'll see this in a second. So let's begin. Before initial CSMs are worked out, you split all contracts into groups. For policies sold in a particular year, you need at least 3 groups. Okay, so what are these kind of minimum required 3 groups? Well, number 1, this is group 1, and it is policies that have a very high probability of being profitable. And you would hope in your business that most of your contracts are going to fall into this group. The second group, group 2, this is equal to policies that have a very high probability, and let's put in brackets, almost definitely of making losses. So this group 2 is a special group, and it's often called onerous or onerous policies. These are policies that are going to cost you money. So that's group 2, and then we have the third group, so group 3, and this is other policies that you think will be profitable. So you're not super sure that they're going to be profitable like you are with the ones you put into group 1, but you're reasonably sure. You think that's where we're going to end up. So of these three groups, groups 1 and group 3, you figure out the profit in respect of them, like we've been talking about in the previous couple of lectures. So let's just make that point. Groups 1 and 3 use the CSM approach we explored earlier. But group 2 is different. So for group 2, a CSM is not used. And expected present value of losses are fully recognized as losses at time 0. So we now have a complication. We're going to do this kind of standard CSM approach where we end up with profit evenly spread when we're classifying policies into group 1 or group 3. But with this group 2 group, we don't do this CSM thing. Instead, we go back to our kind of actuarial instinct and just discount everything and recognize that full expected present value loss at the start. So this means let's just get rid of that. Profits and losses are accounted for differently under IFRS 17. Profits are spread and the losses are discounted and recognised as soon as they happen. If you're sure that they're going to happen, so you could imagine you might have a contract where you think it's going to make a profit, but it might not. That kind of thing's going to go into group 3. Whereas if you're really sure that you've sold something that is not going to be profitable, then it goes into group 2, and we immediately recognise those losses. Okay, I've got a couple of other points to make. First one on group 3. So let's give ourselves some space again. So for group 3, and I'll put in brackets, future. I don't mean I'm going to make changes in the future. I mean, these are about assumptions that affect the future. So for group 3, any future assumption changes that reduce profit initially reduce the CSM each year. So this is nothing to do with experience. This is our actuarial assumptions changing. So if there's an assumption that changes profit, so it reduces profit, then we're going to reduce the CSM that's in our balance sheet that recognises. We're supposed to capture that. However, if something keeps doing this, then eventually the CSM is going to get to 0. So, however, once the CSM hits 0, all expected discounted losses are immediately recognized at that time. So yeah, so you've got your contracts, assumptions change. If you're going to make a little bit less profit than you thought you were, just adjust your CSM. If this keeps happening and the CSM eventually hits 0, then you're effectively treating it as basically as if it's group 2. So all of those, you do your actuarial calculation, discount all the cash flows to the current time, and the loss that you figure out is immediately recognised and emerges as a loss in your profit and loss account. One other thing that's quite interesting about how this is set up is that it forces a degree of honesty on the companies. So let's just put this in brackets. Note that this groupings approach stops unprofitable business from being hidden inside profitable business. So, you know, if you've got something that's loss-making, it's made very clear or captured clearly in the accounts, which is good for all decision makers, like shareholders or potential shareholders. They can see exactly what's going on with the different lines of business that a company sells, and so make sensible decisions about that, about whether they want to own shares or not in that company. Okay, good. I think that's a nice place to stop. That's us covered groupings, and we'll come on to the next section in the next video.